And welcome to our second class in our spring series of financial literacy webinars. I am Alta Simmons, your community relations officer, and I'm joined by my coworker.
Hello, my name is Naomi Bravo, your Community Relations Officer.
And before we get started today, I would like to first give you a little background about who we are. So, Neighborhood Credit Union was originally known as the Dallas Postal Credit Union. And we opened our doors to our first members in April of 1930. And that was just months after the US stock market had crashed. So during the Great Depression, when American confidence in financial institutions was at an all-time low, the Dallas Postal Credit Union won the trust and loyalty of its chartered members. And in 2001, the credit union officially changed its name to Neighborhood Credit Union, which we feel more accurately reflects the diverse base of members from all over the Dallas area that we currently serve. And in 2019, we're excited to announce that the Neighborhood Credit Union Foundation was established to improve the lives of consumers in the state of Texas through promoting financial wellness, providing access to financial education, and raising the overall level of financial literacy. We focus on guidance, assistance, and support in all financial health initiatives, and that's why we're here today. So let's begin. Your credit can have a big effect on your financial life. And your credit report provides a snapshot of your financial habits that financial institutions, even cell phone companies, credit card companies, and others use to get a sense of your credit worthiness. So understanding how credit scores and reports work will actually help you keep your finances healthy and help you achieve your financial goals. And those goals could be, as simple as, buying a new car or purchasing your first home, or even paying off some of your debts. And before we get into why credit scores are important, let's discuss what they actually are. A credit score is a 3-digit rating that tells a lender how likely you are to repay debt. Now, different lenders use different criteria to calculate it. So if you will turn your attention, please, to the slide and consider what range your credit score may currently be along your financial health journey. Now, poor credit is less than 600. So people with a score of 600 or below could probably use help to rebuild their credit history. And if you're like me, you've had issues with credit in the past and you've had to rebuild over time. At Neighborhood Credit Union, we can definitely help you with that. So ask about one of our products, such as our savings builder loan, credit cards, or even personal loans, so we can help you start rebuilding right away. Exceptional credit is between 800 and 850. If your credit score is above 800, you have the strongest credit history and qualify for the best loan terms and interest rates. So remember, these credit score ratings are for informational purposes only. Later, we will learn how credit scores are calculated. So your credit, it can be poor, fair, good, very good, or even exceptional. But one of the most common questions I believe we get out in the field is, what if I don't have any credit history at all? Well, many people, especially young people or people who have recently immigrated to this country, have no credit history. And it's not a bad thing. It's not the same as having bad or poor credit, although people without credit history will face some of those difficulties in getting loans or proving their credit worthiness. However, there are many steps you can take to just start building credit, just like we mentioned earlier. And let's go over a few of these steps now. The first step is to open a line of credit. And this could be a credit card through neighborhood credit union, other bank or retail store even, or a small loan that you can repay on time in full. Special products such as secured credit cards or even saving builder loan or credit builder loans are designed to help you boost your credit. The second step is requesting that your payment history be reported. The third step, which is optional, is to open a joint account. You may request a family member or friend with good credit to co-sign on a loan or credit application with you, but remember that your actions will also affect their credit. Also, make sure joint accounts are reported to the credit bureaus. And finally, step 4. And one of the most important steps I think that we're going to reiterate many times throughout our webinar today, pay your bills on time and in full. Never miss a payment. And I know it's very difficult to do that sometimes, but this is one of the most important steps. But how does your credit score affect your daily life and ability to achieve your financial goals? Well, I want to share some scenarios with you today. And the first scenario is with two friends, Anna and Bella. So they've been friends since middle school. They both own cars and have steady incomes to pay their bills. And you may relate to this. Maybe you've been, at this point at one point in your life. I know that I personally can relate to it because I had a similar experience with my dear friend. So Anna's credit score is 530, while Bella's is 700. Anna and Bella decide they want to buy homes in their childhood neighborhood. So one of them receives a loan without any trouble, but unfortunately, the other has a difficult time getting a loan. When she finally gets approved for that loan, her interest rate and insurance premiums are higher than her friends. And this personally happened to me and a friend many years ago when we were both in the process of purchasing our first homes. My friend, who had been taught how to build credit by her parents from a young age, had a higher score, and myself not being trained and taught these proper tools to have the credit, to qualify, I really did struggle in those early years to rebuild. So much depends on that 3-digit score, as you can see. Who actually comes up with this credit scoring system? I'm sure we're all asking, right? Well, there are many agencies that prepare credit scores, and they can use different models to calculate them. However, the most popular scoring models are FICO and VantageScore, and you may have heard of them before. And there are 3 main credit bureaus in the US, Experian, Equifax, and TransUnion. They, along with lenders, use their own version of a FICO or VantageScore credit scoring models. And the bureaus keep track of your credit history separately. So it's a good idea to utilize each one. If there are large variations or discrepancies among the reports, you should definitely get in touch with the bureaus to figure out why. And credit scores may also be different depending on the financial product you're applying for. For example, mortgage applications may yield a different score for you than if you were applying for a credit card. And when purchasing my first home with my husband, that did actually happen. So you may have experienced that as well. So let's discuss how credit scores are calculated. As mentioned earlier, the different credit bureaus calculate your credit score in different ways. While the bureaus do not disclose the exact methods or formulas they use to calculate your score, we do know the general factors that they consider. The most important factors that affect your credit score are your payment history, right? We talked about that earlier. And secondly, the amount of debt you owe. Now, for more information about calculating a credit score, you can utilize page 3 of your participant guides at your convenience. But let's take a closer look at these factors and others that could make up your credit score. Firstly, payment history. And it primarily includes looking at whether or not you pay your bills on time. And then there's the amounts that you owe. The amount you owe depends on 2 major factors. Number 1 being how much you actually owe on your credit cards or loans. And then number 2, which is really important, what percentage of your available credit are you using? Typically, people who are using less than 30% of their total available credit would be at lower risk for a lender than people that are using 90% of their available credit. So simply put, maxing out your credit card can negatively impact your credit score. And maybe some of us have been there. I know I've been there before. And this was something that my dear friend, her family had to teach me, like they taught her about keeping your balances under 30% of the total, amount that you have available on your card. And next, the length of credit history. So credit history is affected by how long you've been managing your credit. The longer your credit history, the more information a lender has about your repayment habits and, even more important, your reliability. People with a short credit history, even if it's steady and good, may be at a disadvantage because lenders may consider them to be a higher risk. So it's important to build and maintain good credit early and instill these things, into our children as well, right? And new credit or credit that you've recently applied for counts for a smaller portion of your credit score. And each time you apply for new credit, a lender does run your credit score, and it temporarily decreases that score. It does signal that you might be using too much of your available credit, but there are limited exceptions. For example, when you're applying for many mortgages to buy a house in a short period of time, it doesn't tend to affect your score as negatively. And then finally, the types of credit. A smaller portion of your credit score depends on the types of credit you have. So people with a mix of credit types, like having a credit card, having an auto loan, and having a mortgage, may have a slightly higher score than those who only have one type of loan or just one credit card. So if you need help with diversifying your credit portfolio, that is something that we could definitely help you with at Neighborhood Credit Union. And as you can see, credit scores are extremely complex, and your actions and everyday decisions can influence your finances. Now let's discuss how someone else's actions can affect your credit score. A true story about me: when I was in college, my sister got some credit cards and she put my name on a credit card, and she ended up racking up quite a bit of debt on these cards. And eventually, when she couldn't pay them back, she had to file bankruptcy. So you can imagine how much it affected her. 7 years of rebuilding. And then myself, I had to rebuild right out of college my credit after having these credit card charges. So we, must be very careful, with these things. So many people think that co-signing on a loan is helpful action to take, especially if the person is your child, significant other, parent, or even a close friend. Similarly, many married couples or people in long-term relationships decide to merge their finances. But it's also very important to know how this decision may affect your own credit score. And in doing so, I want to share our scenario number 2 with you. So in this scenario, we have Michael and Tamika. They're getting married in 2 weeks, and they're thinking about merging their finances by opening a joint checking account and applying for a joint credit card. So Tamika has a good credit score, but Michael does not. The question is, should they sign up for joint credit? Well, many couples choose to get joint accounts because they're convenient. And it's important to remember that even if a couple merges their finances, they will still have their own individual credit scores. They will not receive a joint credit score. And in this case, Michael's credit score may not negatively affect Tamika's credit score, but it could negatively affect Tamika in other ways. They may receive higher interest rate on a car or a house because lenders may evaluate both of their credit scores to calculate the risk of lending to them. But it's not always the case, as some lenders may only look at the highest score, the lowest score, or both. So it is important just to be aware that your partner's poor or bad score may affect the amount you pay in some cases. And applying for credit on your own or with someone else can affect your credit score. So be mindful of your own credit score before making decisions to co-sign a loan or merge accounts with someone else. Their actions, like not paying back a loan, can damage your credit. And also, their credit score can affect the cost of financial products for both of you. And adding an authorized user to a credit card is also a common way to share credit, but do keep in mind that the primary card holder is responsible for paying the bills. If you both use the card responsibly, it can increase both of your credit scores. However, adding an authorized user can be a risk for a primary card holder if they tend to overspend. So we've talked a lot about credit scores, but what about credit reports? Are they different? Well, your credit report is a snapshot of your credit profile. It includes your history. Every time you take out a personal loan or apply for a credit card, those actions will appear on your credit report. It's important to review your credit report regularly. It's one of the tools to build and maintain your good credit. And the 3 nationwide credit reporting bureaus calculate your credit score based on the factors that affect it. And many people wrongly assume that checking their credit score or report will negatively affect them. That's not true. In fact, keeping an eye on your credit report can help you in many ways. It can help you detect fraud and maintain or work toward a better credit score. You can get your free credit report from each of the 3 credit bureaus per year online or by phone. And we have provided information on the slide for you, as well as on page 4 of your participant guide entitled Getting Your Free Credit Report. There is a step-by-step detailed guide for you. Because you can only request your Equifax, Experian, and TransUnion credit reports for free once a year, think about spacing out your request to maintain an eye on your credit reports every 4 months. So at this point in our webinar, I am going to give the floor to Noemi to go into further details about getting your credit scores. So remember, our question of the day is on the chat box, so please double check that because the answers will be coming up soon. Noemi, please provide us with your knowledge on this important topic.
Thank you, Alta. Well, my name is Noemi. And we're just going to continue the presentation and talk about credit scores, which, unlike your credit history, credit scores are not currently included in your free credit report that's available to you yearly. You can get your credit score by requesting it from various companies, including the different credit bureaus. They all charge fees. Once you've requested and received your free credit report, well, how do you make sense of it? Let's talk about that. Once you have your credit report, you'll find that it has 4 major sections. If you find any inaccuracies or any unknown suspicious details, make sure that you make note of it. The 4 major sections, first of all, you'll find your personal information. In this, you're going to find your name, your birth date, social security number, your address, and as well as the name of your spouse and your employer. The next section will be your public records section. And in this section, if you've had any bankruptcies or judgments in the past, or any unpaid taxes, this is where that information will be. Next is the credit account section. And in this section, it contains information about your debts and whether you have been paying your bills and loans back on time, or if you have been missing payments and are at risk of delinquency. It can also include information about both open and closed accounts. The last section you're going to find is your credit inquiries. And if any organization or people or any agencies have requested to pull your credit in the past 2 years, you'll find the names of the organizations that pulled it. Requesting and reviewing the information on your credit report is the first step toward maintaining and building a healthy credit. So what are some important things to look for? Let's find out. And I'm just going to remind you that there is a question in the chat box. Go ahead and put in the answer to this question and you'll be eligible for the drawing at the end of the webinar. So when you're reviewing your credit, make sure that you look carefully at the following dates. First of all, the date that your account was open. Make sure that the opening or the closing dates of accounts are listed correctly. Next, the date of delinquency. Review delinquent loans and check that the dates are accurate and less than 7 years old. Next, check the dates of public records if you have any. Any public records of legal activity should be erased from your credit score after 7 years. And if it's a bankruptcy, it should be erased after 10 years. And lastly, the dates of credit requests. Whenever anyone, such as a lender, a financial institution, or even an employer requests your credit report, your credit score may be affected. So check the dates to make sure they correspond with your events. If for some reason you do come across information that is incorrect or fraudulent, you can take action. And the first step is knowing your rights. Know that the Credit Repair Organization Act prevents credit repair organizations from engaging in deceptive practices such as false advertising that cause you harm. So in other words, credit repair organizations may not overpromise, for example, to delete all bad credit, whether or not it is legitimate debt that you have accrued. Also, credit repair services cannot demand advance payment, and they must put contracts in writing, and they must offer consumers contract cancellation rights. Your rights as a consumer are protected, but what can you do if you have had bad credit? Let's find out. Repairing your credit means that you'll have to take a hard look at your finances, your bills, and your spending habits. What can you do to repair your credit once it has been damaged? The first step is contact the credit repair bureaus and inform them of any errors or false entries. You can actually create a login information at every credit bureau website. And they make it very user friendly. I've actually been through this process because I found inaccuracies in my credit report. And you select the inaccuracies, and you just follow the process to the end and include any important documents to go with it. Step number 2 is, at the same time that you're doing that, you also need to contact the company that provided the information to the credit repair bureaus and inform it of any errors. The company could be a credit card company, a financial institution, or an employer that denied you service based on information in your credit report. Preventing fraud and fixing incorrect information are important reasons for reviewing and checking your credit regularly. But what happens if you have experienced an unexpected life event, such as bankruptcy or divorce? Well, there are a few steps that you can take to reestablish your credit. And these steps are actually a little similar to building your credit. Step number 1 is monitor your credit report and scores. The next step, again, we are reiterating how important this is pay your bills on time and regularly. Nothing builds your credit faster than regular and consistent payments. Step 3, you can also get credit counseling. And actually at Neighborhood Credit Union, we work with a nonprofit organization called Green Path Financial Wellness, and they offer free credit counseling for our members. So they can advise people about money and debt management, and they can create a financial plan for you. And in addition to all of that, they also offer workshops. So we're going to put their information on the chat box, and let us know if you have any further questions on that. The final step is considering financial products. So at Neighborhood Credit Union, we do have a specific product that has helped many members build their credit score to where they wanted it to be. It's called the Saving Builder Loan. And like I said, this product is designed for you to start building good payment history, and start getting that good payment history with the credit bureaus, and in turn, building your credit score. So let us know if you have any questions on that. Okay, so how can you identify potential scams from any credit repair companies? So for that, let's return to Anna. She has been unable to pay her mortgage and her house has fallen into foreclosure. She researched several credit repair companies. Let's see if we can help her recognize the good from the bad. So the first company promises to remove bad credit information from Anna's report. All she has to do is pay an upfront fee. Anna is worried about her bad debts, but the company assures her that it can scrub all negative information from her report. The company also advises Anna not to contact the credit bureaus directly, since doing so will negatively affect the company's efforts. So in this scenario, there's a lot of red flags. So let's go ahead and discuss the red flags here. First of all, the company that Anna was working with promised to remove bad credit information from her credit report, and they also required her to pay fees to remove bad credit notes from her report. And as we mentioned before, according to the Federal Credit Repair Organization Act, Credit repair companies must successfully remove the credit inaccuracies from your report and provide proof that the report has been changed before they can request payment for services. And this process can actually take up to 6 months. So that's a red flag. You should also be suspicious of any company that promises or guarantees to remove all bad credit information. That's also a red flag. So in this scenario also, Anna was worried that some of her bad debt would continue to bring her credit score down, but the company assured her that it could remove all her bad credit, including the items that were legitimate. Credit repair companies can only remove negative credit information if it is incorrect or if it's a result of fraud. So if a company requires you to claim that accurate information on your credit report is false, that's a red flag. The credit repair company also advised Anna not to contact the credit bureaus directly. So you should never trust any company that recommends or advises against contacting the credit bureaus. That's a red flag. To recap, there are many red flags you can spot in a credit repair scam. Other signs that you can spot is anyone that asks you for a signature on blank paperwork. There's also the credit profile number scam, and this is promises of a new credit identity by issuing a credit profile number or a credit privacy number that is similar to a social security number, and that's a scam. And the next one is also similar to it, which is the fake social security number scam. And this would be if an agency encourages you to use a fake social security number. Well, if your credit report is poor, like I said, you may consider taking advantage of credit counseling. And I'll go ahead and mention it again with GreenPath Financial Wellness. You can definitely take advantage of their free credit counseling services. You can find their information. We're going to go ahead and put it in the chat. But if you choose to shop around, we recommend that you look for agencies accredited with either the National Foundation for Credit Counseling or the Financial Coaching Association of America. So we're nearing the end of our presentation, and I just want to leave you with a good few strategies that you can implement in your daily life. So a few good habits and strategies around managing your credit and debt can go a long way toward helping keep your credit score high. So here's a few strategies. First, use your available credit wisely. Use less than 30% of your available credit and not max out your credit cards. So to put it in dollars, say that you have a credit card with a limit of $1,000. Now, we suggest that you don't use more than $300 a month, and also that you try to pay it every single month. That's the best way to use a credit card so that it works for you. Pay your bills on time and pay off your credit card bills each month in full if it is possible. Next is pay off your loans on time. Not only does defaulting on your debt cost you in fees, it will quickly damage your score. Next, don't apply for several credit accounts in a short period of time. I have known of many cases in which people that are barely starting with their credit history, they get really excited to just get started and they go ahead and apply at several different credit card agencies. So remember that every time that your credit is pulled, it's actually going to affect your credit score. So you really want to limit the amount of credit inquiries in a short period of time. The next strategy is make a financial plan or a debt management plan to reduce debt. And I would like to just mention that we will have another workshop at the end of the month on the topic of making budgets work. So this is going to be a great workshop to help you create that budget to reduce your debt. The next strategy is create and follow a monthly budget. And lastly, periodically review your credit report for accuracy. Okay, so we've actually reached the end of the presentation. I just want to leave you with a few points. A good credit score can help you achieve more of your financial dreams. Keep track of your credit reports and regularly review them. It can definitely be an uphill battle, but remember, we're always here to help. And just making good choices now can really help you in the future. So at this time, we're going to end the recording.